This hearing of the Subcommittee of Financial Institutions and Consumer Credit will come to order. Good afternoon, and thanks to all of the witnesses for agreeing to appear before the subcommittee today. Today's hearing is a legislative hearing that will examine H.R. 1214, the Payday Loan Reform Act of 2009. We will be limiting opening statements to 10 minutes per side, but without objection, the record will be held open for all members' opening statements to be made part of the record. I yield myself 5 minutes. Over the last 2 decades, payday lending has become a very controversial source of credit in many of our communities. The payday loan industry has grown in size from roughly 300 offices in 1992 to over 24,000 last year. As our constituents are faced with even tougher economic conditions during this recession, they are more and more likely to turn to the services offered by payday lending industry to pay for emergency car repairs, an unexpected doctor's bill, and even groceries for their families. Many of these families have been ignored or shut out of the mainstream financial services industry and have nowhere else to turn for credit. The last hearing on payday lending in front of the House of Representatives was held in March of 2007, and much has changed in those 2 years. More states have enacted protections against abusive payday loan practices by enacting cap rates or by banning payday lending altogether. A select few states like New York, North Carolina, Pennsylvania, and West Virginia have banned payday lending altogether, and many states do not offer their citizens even a decent level of protection against abusive payday practices. And 7 states fail to have any cap on small loan rates. Missouri, for example, has an APR cap as high as 1,955%. While I have and will continue to support consumer groups' tireless efforts to eliminate abusive practices in the lending industry, they are fighting an uphill battle against better-funded lobbyists in states like Delaware, New Hampshire, and Wisconsin, where there is no rate cap at all. As we can see from this chart, we have the chart? As we can see from this chart that separates states into 3 classes: those that have banned payday lending, those that, it's the first, those that cap interest rates for payday lenders at 15% or 391% APR, and those that either have no cap at all or have a cap in place that exceeds 391, which is the largest number of 26 states there. The column of my bill is to move all 23 of the states in the far right column over to the middle column. Then the consumer groups will have a realistic opportunity to work their magic and move as many states as possible over to the far left column. By the way, that column on the far right represents almost 113 million Americans that would be helped by the bill. The current state of affairs for those consumers is unacceptable, and Congress would be derelict in its duty if we allowed them to remain unprotected from abusive and predatory lending. H.R. 1214, the Payday Loan Reform Act of 2009, creates significant protections from abusive payday practices by preventing rollovers and freeing consumers from the debt trap by mandating a cost-free 90-day repayment plan. The bill lowers the effective APR of a payday loan to 48% or 15 cents for every dollar loan. This is a rate that is lower than the 23 current state rate caps, including California, Colorado, New Hampshire, and even my home state of Illinois. My legislation would also prohibit unfair mandatory arbitration clauses, increase disclosure, and honor all existing stronger state protections by creating a federal floor on which stronger laws can be built on. We may hear from the consumer groups today that a similar law that was passed in Illinois has been a failure. But according to the State Department of Financial Institutions, Illinois' 15.5% rate cap has already saved consumers in our state over $35 million since its enactment in December of 2006. My bill would move that rate cap even lower. I recognize that my bill is not a cure-all for this issue. My intent with H.R. 1214 is to give the efforts to protect consumer rights a boost by creating a minimum level of protection that all consumers will enjoy. This legislation would lower the APR cap for nearly 113 million Americans immediately upon its enactment. Despite complaints from the industry that the bill sets rate caps too low and assertions from consumers that bill does not go far enough, I think that improving protections for 113 million consumers is a significant step in the right direction. The status quo in the payday industry is unacceptable. The Payday Loan Reform Act says no to the status quo. It would protect millions of Americans from abusive lending practices in one fell swoop. I look forward to hearing the testimony of our panelists and also look forward to a lively debate on this controversial issue. I yield the gentleman, Mr. Hensoning, 5 minutes for his opening statement.
Thank you, Mr. Chairman. Congress and the Financial Services Committee continue to enact legislation that contracts credit in the middle of a recession. There was the mortgage cram-down that made mortgage loans more expensive for some, inaccessible to others. Just a few moments ago, the credit card bill, which will deny credit to some, make it more expensive to others. Now we have the payday lending bill. The bill before us, I fear, essentially does two harmful things. Number one, it establishes price controls. Number two, it erodes risk-based pricing, which permits people, particularly low-income people who haven't had access to credit before, to finally have access to needed credit. What will the outcome be if we pass this legislation? Again, consumers will lose. They will lose choices, they will lose credit, they will lose economic freedom. What will they gain? They will gain bounce checks. They will gain utility reconnect fees. They will gain eviction notices, and they will gain the opportunity to be forced into the underground economy. Now, I continue to observe, particularly I've been involved in the budget debate on the floor and listening to my colleagues on the other side of the aisle here, how many talk about the benefits of the free enterprise system, yet we continue to have legislation after legislative initiative that appears to attack it and erode it daily. I would remind my colleagues, just because you don't need or don't appreciate a particular service doesn't mean that your neighbor doesn't. Now, I know we will hear a number of sad stories about people who are caught up in cycles of debt, and I assume they are all true, and my heart will go out to these people. But I wonder, though, if this never-ending cycle of debt that we hear so often, is that a symptom or is that the cause? My belief is it is probably the symptom. And indeed, I have a quote from a recent Federal Reserve study that said, quote, "There is no evidence that loan rollovers and repeat borrowers affect store profits beyond their proportional contribution to total loan volume. In other words, the industry's profitability does not depend on the presence of repeat borrowers per se," unquote. So I believe we need to go to the root cause of the problem, not the symptom, the root cause of the economic turmoil that are affecting the lives of our citizens. We need to pass policies in this Congress and in this committee that will help preserve our fellow citizens' jobs today and grow better job opportunities tomorrow, and prevent punitive taxes from shrinking their already shrinking paycheck. I have a suggestion. We could start this afternoon. We could start this afternoon by rejecting the Democratic budget, which establishes a national energy tax, which CBO says could impact families at $1,600 a month, $300 billion of new taxes for small businesses with all the associated layoffs that would be associated with that. Again, if we pass this legislation, I believe that consumers are going to be forced into many alternatives that they may find more harmful to them. The average telephone reconnect fee is $50. Maybe many consumers would have preferred to pay the $15 market fee to borrow the $100. The average cable reconnect fee can be as much as $100. Again, there are many consumers who would prefer to pay the $15 than the $100 reconnect fee. A bounce check can average $28.23. You add overdraft fees can be $56. Now, if we get focused on APR, which may or may not be the best way to judge these loans, a bounce check can have an APR of 755%. You add the overdraft fees, all of a sudden on that same $100 loan, you're at 1,449%. The chairman of the FDIC has said, quote, when used on a recurring basis for small amounts, the APR for fee-based bounce protection far exceeds the APRs associated with payday loans. And given that these tend to be small, short loans to people who are credit risky without collateral, there are fixed costs associated with these loans. The default rates are high. Of course, this APR is going to be large. But why take away the option of what the consumer wants to do? Why replace his judgment or her judgment with ours? The answer is economic growth, economic opportunity for our neighbors, a competitive market, and effective disclosure. Mr. Chairman, thank you, and I yield back the balance of my time.
Gentleman yields back the balance of his time. Mr. Moore, you're recognized for 1 minute.
Thank you, Mr. Chairman, for holding this hearing and your hard work in drafting H.R. 1214, the Payday Loan Reform Act. I'm proud to be a co-sponsor of this balanced legislation, and whenever we have industry on one side saying the bill goes too far and consumer groups saying it doesn't go far enough, we're probably striking a close to a proper balance. In Kansas, we already have laws in the books protecting consumers that are nearly identical to 1214. Our state law already limits a maximum fee of 15 cents per dollar advance and bans rollovers. Applying these kinds of consumer protections to all states would probably permit states with tougher payday lending laws to maintain those requirements, I believe, is the right approach. Thank you, Mr. Chairman. I yield back.
Thank you. We have Mr. Paulson is recognized for 2 minutes.
Well, thank you, Mr. Chairman, also for holding this hearing today. At a time when the credit markets are frozen or are certainly drying up, I think it is very important that we ensure that we bring as much liquidity into the market as possible. And we need to make sure that there are as many options as possible that are available for consumers. I found it interesting that a recent report by the Federal Reserve Bank of the state of New York noted that payday lenders fill a very valuable niche market where banks and credit unions have left a void. The study found that people in those states that banned payday loans, they bounced more checks, they filed more complaints about lenders and debt collectors, and they filed for bankruptcy at a higher rate. So I want to make sure that any legislation that is pushed through by Congress does not exacerbate those effects throughout the country. I certainly understand the goals of protecting consumers, but we must make sure that credit is available for those who need it. I also have some concerns about the preemption portions of the legislation, which we'll have discussion on. There's a patchwork of legislation out there right now through all the different states, but I want to make sure that we don't mire down the payday lenders with over-regulation. I look forward to the testimony today from our witnesses, and I yield back to the chairman.
Congressman Baca, you're recognized for 3 minutes.
Thank you very much, Mr. Chairman Gutierrez and Ranking Member Erlington, for your leadership on this important subject. The issue of payday advance lending reform is a critical one, and I applaud Chairman Gutierrez for introducing the legislation on this subject. As some of you know, I've introduced an alternative legislation on this issue. I believe that my bill, H.R. 1846, the Consumer Lending Education and Reform Act, or the CLEAR Act, reforms the payday loan industry while also ensuring that borrowers have access to loans when they are needed. In these difficult times, students, police, officers, teachers, and other working Americans and sometimes need access to emergency credit. These people, like Tina Hall, who would not have been able to pay for her daughter's emergency dental care if it hadn't been for payday loans she received. And I received like about 47 different letters just in my area, and I'd like to just read one of them. It says, "Dear Congressman Baca, I've come to blank for the payday loan." I'm not going to give advantage to that one. "I use the services during emergency. This is a good service to have when you need some money real quick. I feel this is a good service. Please don't take it away." Again, we must have access to credit open to borrowers like Tina and this person that I just read, who are doing the right thing. But we also must have a cleanup industry with tougher regulations and consumer protections and oversight. The CLEAR Act achieves these principles while also imposing a strict national fee structure on payment loans. My bill caps it at 15 cents per dollar plus allowance for a 5% original fees for loans borrowed over the internet. This additional 5% fee for the internet loan is due to higher consumer acquisition costs. My bill limits borrowers to refining a loan to no more than 2 times at a rate of 15 cents per dollar for the first refinancing and 10 cents per dollar for the second refinancing. The CLEAR also requires lenders to obtain bonding to follow the Fair Debt Collection Practice Act and to advise borrowers of the availability of free credit counseling. These provisions will eliminate the fly-by-night lenders who take advantage of vulnerable individuals. It is my preempting existing state law, the CLEAR Act would create a national standard, and I state, create a national standard for short-term loans. This will ensure residents of the 50 states have access to payday advance loans at affordable rates. We must remember that for many of our customers, advance loans are more effective than other alternatives, as you can see by the chart that we have out here. If a customer who overdrafts protection on his or her checking account writes a $100 check but only has $75 in the account, the bank charges them somewhere approximately around $38. If a customer who does not have an overdraft protection bounces the same check for a $100 check, they will be charged $30 check. If I can have an additional 30 seconds.
There is no further time.
Can somebody yield to me?
Well, we could try it. We recognize Mr. McHenry for 3 minutes.
I'll yield my colleague 30 seconds.
Thank you. Thank you very much. Just to finish up, then if a customer does not have the overdraft protection, the bounce check for the same $100, they will be charged $30 for a bad check, which means both the bank and the merchants are giving them a total of $60, so they're actually paying more than going to a payday than what it would be otherwise. The CLEAR Act provides national regulatory reform that contains consumer protection and oversight, while also ensure working Americans have access to credit. I thank the chairman for recognizing me, and I look forward to working with him and other members on this important issue. And thank you very much for yielding the time.
I thank my colleague, and thank you, Mr. Chairman. Thank you. I thank the ranking member as well. There's going to be a discussion about the North Carolina experience today. In North Carolina, we simply do not have payday lending recognized by the state. The failure of state regulation means that there are no state-chartered institutions that are allowed to do payday lending. However, payday lending still occurs, even though illegally in North Carolina. There are mechanisms to do that. We have individuals that drive over the state lines to do that. We have those that access other opportunities via the internet. We have other individuals in the state that access credit through simply unregulated means, period. The North Carolina experience is not a good one in terms of access for low and moderate income individuals to access opportunities for lending. So the North Carolina experience we need to be clear about. Mr. Chairman, I ask unanimous consent to submit a Federal Reserve and New York staff report on payday credit bans.
Without objection, so ordered.
Thank you, Mr. Chairman. And beyond that, this is the worst time to further constrict credit. We see with the recession, with the impact on other traditional means of lending, the constriction within our credit markets, the access of credit has been severely limited right now. The impact on families is real. And so we need to have regulated means of individuals being able to meet their demands, their worldly demands of paying their car payment, making their home payment, paying their rent, even feeding their kids. This is a very basic function. I want to commend the chairman, though I've got concerns about his legislation. I do appreciate the fact that he's approached this in a pragmatic way and that we can have a realistic discussion on how we can properly allow for the function of the credit markets in many different ways in this country. And I'm very grateful for the opportunity to have this discussion before this committee. I think it's important, especially now in these tough economic times, that we have this discussion about the importance and the necessity of payday credit advances. Thanks so much, and I yield back.
Gentleman yields back the balance of his time. We have Mr. Scott for a minute and a half.
Thank you very much, Mr. Chairman. Let me just say very quickly, these are tough times, and with the tumultuous financial markets, bank bailouts, rising unemployment, continued downturn of our housing markets, many working and middle-class Americans indeed are finding it harder and harder to make ends meet, and some are turning to short-term loans to get them over certain hurdles. This is a market. These are consumers. These are our constituents out there who do need help. I think what we're trying to do with this legislation, which I am a co-sponsor of, Mr. Chairman, as you know, we are asking and reaching for what I would refer to as a delicate balance. And that delicate balance is to make sure that those of our consumers, those of our constituents who need, in an emergency situation, to have access to safe and protected and fair means of acquiring funds that they need to get them over in a tough time. But yet, we must do it in a way that they protects them from getting caught in long-term debt and a cycle of debt. This bill will not put payday lenders out of business, but what it will do is it will cause this industry to lose some profits, but all of it at the expense of ensuring that those 23 states with weak or even no payday lending rules will receive increased protections from those that are less than honest lending practices. The bill will not preempt states that already have laws on their books that may be stronger or even outlaw some of these practices. And there are those that say the bill does not go far enough. There are those that say the bill goes too far. But again, Mr. Chairman, what I feel we have here is a bill that does reach that delicate balance that is needed to give access to credit in these tough times to those folks that need it, while at the same time providing maximum protections for our consumers in this industry. And I yield back the balance of my time.
Gentleman yields back the balance of his time. I ask unanimous consent to add an additional minute for opening statements on each side. Hearing no objections, so ordered. Mr. Ellison, you have 45 seconds.
Thank you, Mr. Chair. Sadly, there are millions of hardworking Americans out there without checking and savings accounts. These are the unbanked. Until we change that, until we make much greater progress in areas of financial access, we will continue to have payday lending industry. In the meantime, we have to make sure that all consumers using payday loan products are protected. For that reason, I want to commend you, Chairman Gutierrez, on your leadership in convening this important hearing on payday lending reform. In sum, I believe the legislation makes a lot of progress towards striking a balance between ensuring basic protections for consumers and not stifling their access to credit. However, it's only a first step of many to provide affordable financial products to all Americans. To that end, I'm especially interested to hear more about these efforts of regulated financial institutions like community banks, credit unions, and others to bring millions of unbanked Americans into the fold of the mainstream financial services industry. Thank you. I yield back.
Thank you. Mr. Henselin, you're recognized for one additional minute.
Thank you, Mr. Chairman. Not unlike the gentleman from California, I've heard from a number of my constituents. I've heard from a lady named Teresa in Dallas, where I live, a 43-year-old divorcee who recently survived stage 4 cancer. She wrote to me and said, "Congressman, without these loans, I would have been evicted from my apartment on 2 separate occasions. Please help to keep these loans from being banned. There are many of us out here with no other choice at all." I also heard from Paul of Mesquite, Texas, quote, "Working payday to payday in this economy, we sometimes need a quick loan for food, gas, utilities, prescriptions. If payday loans are banned, our checks may have to bounce, and then I have to pay the big banks' overdraft charges." I won't name the name of the company. Payday lenders are helping working Americans stay afloat till payday. Mr. Chairman, I hope we keep in mind Teresa of Dallas and Paul of Mesquite as we go through this debate, and I yield back the balance of my time.
We certainly will. Mr. Meeks, you're recognized for 45 seconds.
Thank you, Mr. Chairman. I just want to say real briefly, you know, I wasn't always a member of Congress. In fact, I didn't always wear a suit like this. I grew up in a neighborhood that it was tough. My parents had no money, and what this is about options. It's about options. It's about options that average, everyday people, good people can have if, in fact, they find a hard time. In fact, it could save their credit. Because if you, not only by paying a late fee, it ruins your credit and stops individuals who have aspirations to own a home one day, because when they want to go in that home, if they didn't pay that back to the bank because they paid late, then their credit rating goes down and they're not able to afford a house to even move themselves up. This is about options. We had some concerns. This bill addresses the concerns to protect consumers. You know, no rollovers, a fee capped at 15 cents for every dollar. You know, defaults extended as far as repayment is concerned, so and among others. So in my brief time, I just want to say that this is for everyday people, and I cannot just give the don't have to give the testimony of what someone has given me. I can tell you that I've lived through it. And I've seen the results when someone doesn't have options. I've seen them to go to someone else who gives them that option, and when they don't pay back, unfortunately, sometimes they come back without a limb. And we need to stop that. I think this is a good bill, and I support it.
Thank you. Okay, we have some great witnesses. We're going to hear from them now. Testifying first before the subcommittee is Ms. Jean Ann Fox, who is the Director of Financial Services for the Consumer Federation of America. But she's also testifying on behalf of Consumer Action, Consumers Union, and the National Association of Consumer Advocates, the National Consumer Law Center, as well as U.S. PERT. Please, Mrs. Fox, you're recognized for 5 minutes.
Thank you, Mr. Chairman, Ranking Member Henserling. I appreciate the invitation to come and testify before you today. I'm also representing the Woodstock Institute in Chicago. We appreciate your interest in protecting consumers from the payday loan debt trap that results from these extremely expensive balloon payment loans that are secured by direct access to consumers' checking accounts. Payday loans are harmful to borrowers. They undermine scarce family resources. They risk bank account ownership. They double the risk that you'll end up in bankruptcy or seriously delinquent on a credit card payment. When you study actual payday loan borrowers, you find that these products are harmful to the families who use them. We agree that payday lending and similar products should be reformed, but we respectfully disagree with the specific methods used in H.R. 1214. The bill authorizes single payment loans for as short as a day or two at a cost of 391% APR for a 2-week loan or 782% APR for a 1-week loan. The bill sets up an unaffordable repayment term. It has to be repaid in full out of your next paycheck that's deposited to your bank account. Otherwise, you'll end up paying bounce check fees to the payday lender and to your own bank. A family making $35,000 a year, which is a typical payday loan income range for borrowers, would not be able to pay a typical $300 loan back out of their next paycheck, even if the loan were free. These are simply unaffordable single payment loan terms. The bill also authorizes loans to be secured by unfunded checks. In other words, to get a payday loan, every borrower has to write a check when they have insufficient funds in the bank at the time they write it, or they sign over electronic control of their bank account to the payday lender. This bill authorizes lenders to turn a debit authorization into a paper check that takes money out of a consumer's bank account, depriving them of current protections they would have under the Electronic Funds Transfer Act. The narrow definitions of a payday loan and of a creditor in this bill also means that it's easy to evade the application of the law. For example, the chairman mentioned the Illinois experience. Illinois defines a covered payday loan as 120 days. So most of the big payday lenders turn their product into a 121-day or longer loan, and they're not subject to the rate cap or the other provisions in the Illinois payday loan law. There are other loopholes in this bill. It doesn't cover opened-end credit. Most of the big payday lenders in Virginia turn their product into an opened-end credit to get around changes to the law that took effect this year in Virginia. In Texas, almost all of the payday loan business is done under the Credit Services Organization model. It is doubtful whether this bill would apply to those payday lenders in Texas. The chairman has mentioned that at least rates would go down in some of the states where rate caps are set higher than $15 per hundred. However, in 10 of those states, there's no rate cap for an installment loan. So there would be little barrier to the payday lenders just changing their product into a 91-day installment loan and continuing to charge even higher interest rates. The protections against the payday loan debt trap in this bill are well-intentioned, and we appreciate that. But they've been tried in other states, and they don't stop payday lending from being a debt trap. The average customer has 9 loans per year, even in states that limit you to 1 loan at a time, or that prohibit renewals, or that have repayment plans. As long as you allow this product to be offered under the terms of a typical payday loan, you'll have a payday loan debt trap. Congressional approval for a bill that caps rates at this high rate will undermine the momentum in other states. For example, at the ballot box last fall, voters in Arizona rejected a ballot initiative that had the same rate cap, the same kind of repayment limits as are included in this bill. Voters rejected 391% lending in Ohio, and the trend at the state is away from legalizing payday lending. The momentum is toward restoring conventional small loan rate caps, and I fear that passing this bill would undermine that momentum. We urge you to ban loans secured by getting consumers to write unfunded checks, and we urge you to support the rate cap in Representative Spears' H.R. 1608, which would provide real protection for all forms of
Thank
credit
you.
to all consumers.
Try to give the gentlelady a little more time since she's against the bill so that we can show fairness here. But I hope we won't all continue, Mr. McCullen, as your next President, Chief Executive Officer for Finance America of Louisiana. You're recognized for 5 minutes.
Thank you, Mr. Chairman. Members, it's an honor to be here today. I own the largest small loan company in Louisiana and operate 30 locations. I am also president of the Louisiana Cash Advance Association and working closely with the Louisiana Legislature and the Office of Financial Institutions help to draft and implement the laws that we currently operate. Our laws are working, and I want to offer you information that will help you in your decision-making process. From the beginning, we had two specific goals in mind: provide structure to a service that customers need and want, and implement tight consumer protections. All lenders are licensed, regulated, and extensively audited by the Office of Financial Institutions, and I believe we have one of the best consumer protection laws in the country. If you want a national standard and want to implement something that will work, implement Louisiana's law. As with any new industry, ours has certainly had its problems, and there have been bad operators just as in any industry. But with lots of hard work, things are leveling out, and in Louisiana, the number of lenders is actually dropping. This phenomenon happens in every new industry, and it's the way our country's free market system works. Businesses rise and fall based upon consumer demand. I believe we will continue to see downward adjustments and consolidations in the future. Louisiana's law provides for full disclosure of all fees and terms on the promissory note, including APR. It prohibits companies from accepting fees to roll over, flip, or renew a loan. This is one of my personal hot buttons, and our law keeps consumers from getting into a cycle of debt. Our law allows for the collection of reasonable attorney's fees and court costs and mandates the posting of a fee schedule and the Office of Financial Institutions 800 number for complaints. The maximum fee allowed on a cash advance in Louisiana is 16.75% of the face of the check. This means when someone borrows $100, the fee is $20. If they borrow $200, the fee is $40. No compounding, no excessive fees. There is a $45 fee cap, and like other lenders, we are allowed a $5 documentation fee. There are very few complaints. In fact, Louisiana had over 4 million transactions in 2008, and regulators only received 24 complaints, and only 2 pertained to excessive fees. While we are an open book and disclose all fees in the promissory note, I believe we should be taken out from under the truth in lending. Ours is a fee-based business, and APR should not apply. Money is just like any other commodity, and applying APR to our business skews reality and is illogical. I compare our business to a AAA Renault store. You can buy a hedge clipper at Home Depot for $100, or you can rent it from AAA for $20. Our customers rent the same way. It's just our product is money, and they pay a fee for the convenience. If they do not need our service, they will not come in. An example of how someone would use our service is if they bounce 3 $50 checks. The total fees could exceed over $150. If the same person borrows $150 from one of our stores, the fee is around $30. $150 versus $30. It's that simple. Defaults are a constant problem. If a $300 loan customer charges off, 7 other customers must pay in order for us to break even. Louisiana's law could be better by allowing us to reduce or control bad debt in a better way. Some states have implemented a database which allows for only 1 or 2 loans at a time. I am not in favor of the database, but controlling consumer bad debt would be a benefit. We use Teletrack to track data, and if a customer has more than 1 loan, we will not loan to them. If they have charged off somewhere else, we will not loan to them. The consumer groups want you to believe that we are trying to put people deeper into debt, when in reality, we want our customers to pay and not default. It's perception versus reality. The consumer groups have done an excellent job of spreading this information, and I've realized that perception can become reality when repeated enough times. But the horror stories you see in the newspaper and on television are not reality in Louisiana. And for the record, we are not predatory, and we take no collateral, and there is nothing to take away. Again, the consumer groups are spreading incorrect information, and they know it. They have hijacked the word predatory and are incorrectly applying it to us. Predatory lending applies only to the mortgage business. It has nothing to do with rates or fees or APR. If it did, every NSF fee would be considered predatory. According to the recently released FDIC study of bank overdraft programs, the average $66 check that bounces and is repaid in 2 weeks incurs an APR of over 1,000%. A $60 ATM overdraft that is repaid in 2 weeks incurs an APR of over 1,100%. ATM overdrafts and NSF overdrafts paid by the bank for their customers are extensions of credit. I'm not suggesting that you apply APR to these extensions of credit, but my point is that if you apply APR to us, then the same should be applied to them. I'm comparing apples to apples. If you exempt them...
Time of the gentleman has expired. Testifying third is Mr. G. Michael Flores. He is the Chief Executive Officer of Bretton Woods Incorporated, a management consulting firm. And Mr. Flores, the chart that you brought is going to be to my left, your right. Sorry, we can't put it on the other side, closer to you.
Thank you, Chairman Gutierrez, Ranking Member Hensterling, and members of the committee. I am CEO of Bretton Woods, Inc., a management consulting firm, and my clients include banks, thrifts, credit unions, payday lending industry, and bank technology companies. I have more than 30 years' experience and have taught at the Graduate School of Banking in Madison, Wisconsin, and the Pacific Coast Banking School in Seattle, Washington, and published several articles and studies on the financial services industry. In essence, my business is helping banks improve profitability. Because this hearing is about payday lending, I am here today to put this in the context of the bigger picture, the short-term unsecured credit market. The short-term credit market is made up of products and services for people who need a small amount of cash for a short period of time. It is more than a $70 billion market that includes credit card over-limit fees, overdrafts, NSFs, and payday loans. Additionally, the market includes tens of billions of dollars in late fees or reconnect fees, as has been mentioned earlier. All of these credit products are short-term and all unsecured. Currently, banks and credit unions control the largest share of this market. That may come to surprise to some people because very few banks offer the unsecured short-term dollar products that we typically consider to be a loan. As the committee may know, only 30 banks have signed up for the FDIC Small Loan Pilot Program, which was designed to see if alternatives to payday lending could be offered profitably. The results are not in, but I'm not encouraged that they will be profitable or encouraging. I have worked with banks over these years, and this legacy cost structure of banks inhibit their ability to offer these small dollar short-term credits in a profitable manner. So what role do banks play in the short-term credit market? Well, primarily through insufficient funds, known as bounce check fees, and overdraft protection. These products are all part of a competitive marketplace and all considered alternatives to payday loans. If you'll refer to our first chart here, the pie chart, I published research I conducted in November and December of 2008 and recently updated in early March of this year, and found that banks and credit unions earned $34.7 billion in combined NSF and overdraft fees. By comparison, the late and over-limit penalties on credit cards was $20 billion, and payday lenders earned $7.3 billion for 2008. As been mentioned earlier in your hearings 2 weeks ago on overdrafts and credit cards, these fees for banks are an increasingly significant source of revenue for these banks. As a matter of fact, if these fees were eliminated or reduced, many banks would be unprofitable in this country. Now, from the consumer's perspective, when a consumer doesn't have enough money to pay a bill in his or her checking account, then they have the option of either bouncing the check, using overdraft protection, getting an advance on a credit card, or using a payday loan. If you look at chart 2, please. Been mentioned earlier about the FDIC study. That average cost of a bounce check was $66, or the average amount was $66. For that transaction, the consumer would pay $27 in overdraft fees. If they did not have overdraft protection, the fee would be averaging almost $29 to return the check, plus a merchant fee of over $26, payable to the merchant to whom they wrote the check. In comparison, a customer who took out a $66 payday advance would pay approximately $10.56 based upon 16 cents per dollar advanced. Just by looking at the household data, you can get a sense of which option is used most. And this is one of the major points I want to make today. If you would bring up the next chart, please. There are approximately 101 million households with checking accounts in this country. In states where payday loans are available, on a national average, these households pay approximately $343 in NSF and overdraft fees per year. In states where payday loans are available, the average household pays $239 per year. And in states where these loans have been eliminated, the average household pays $496 a year in NSF and overdraft fees. Now, I want to stress that I don't maintain that there is a direct relationship, but I think this is a significant indicator and should justify an extensive and robust study considering all the variables to determine if there is indeed a direct correlation between availability of an option such as a payday loan and the impact on NSF and overdraft fees. In conclusion, I'm a proponent of competition and I'm a proponent of options for the consumer. As long as there are options available, the consumers are smart. They will look for the best value at the lowest cost, and I would hope this legislation strikes a balance that encourages competition and not reduces competition. Thank you.
Thank you very much. And now we have, last but not least, we have Ms. Gerri Guzman, a resident of Montebello, California, who is coming before us today to discuss her role as a payday lending consumer. You're recognized for 5 minutes, Ms. Guzman.
Thank you. Good afternoon. My name is Gerri Guzman. I'm a resident of Los Angeles County in California. I currently serve on the Montebello Unified School District Board of Education, where I serve 33,000 kindergarten through 12th grade students and their families, 78% of whom qualify for free or reduced lunch. I am also active in the following organizations: Sir Optimus International, the Boys and Girls Club, and my local chapter of the American Red Cross. I have also been a payday lending customer, and I'm here today to talk about that experience. I am thankful for the opportunity to be here, as I think sometimes with issues like payday lending, the opinions of the people who actually use the service aren't often heard. I also would like to add that when my city considered a moratorium on payday lending business licenses, I took the opportunity to meet with several community members to listen not only to their experience, but to gain an understanding of why my community uses payday lenders. Personally, I consider payday loans to be a necessary evil. If I had the choice, I would never have been in the situation where I needed a payday loan. I'm sure this rings true for tens of millions of lending customers around the country. In a perfect world, we would all have the money set aside in a savings account to cover the expenses that are unexpected or unavoidable. But having much money in a savings account is not a reality for many working families, especially today. I first became a payday lending customer when I decided to leave my job and become my mother's primary caretaker before her passing, 14 months prior to her passing. I did not regret for a moment my decision. However, I would be lying if I told you it didn't create a temporary financial hardship. At the time, my options were to take out a payday loan or not to purchase a water heater. I was aware of the cost of the payday loan and decided that it was the best option for me at the time. Thankfully, my financial circumstances have changed, and although I am no longer a payday customer, I would like to know that the option is available should I need to be again. I do wish that there were more choices and better choices for consumers, but in reality, there are not. There are more choices in tough financial times people have, the smarter decisions they can make, and the better off they will be in the long run. I, like most people in this day and age, are budget conscious and look for the best options available in all situations. I knew what a payday loan would cost, but the bottom line is the process was simple and quick. I'm aware that payday lending customers often get themselves into trouble, and some people make poor choices and get caught in a debt spiral. But certainly this is not unique to only payday lending customers. I do think that it is important that government protect people from predatory lenders and abusive practices. I would like to see a mechanism in place to minimize the likelihood of payday lending customers getting trapped in a cycle of debt. I am sure that most people intend to pay off their loan when it's due, but often, unexpectedly again, the money is not available. In these situations, it's important that a lender work with the borrower to make sure they aren't worse off than they were before. An adjusted pay plan would be very helpful to my consumers and certainly be more realistic. It would also be helpful to make it easier for customers to compare credit products. Most of my neighbors are hardworking middle-class and lower-class families. Very minimal health care insurance often makes it a necessary situation to make a choice of making a payday loan or having bounced a check or doing without the necessary services. It would be helpful to make it easier for customers to compare those products. Companies need to be upfront and clear about how much the borrower will pay for the loan and when it is exactly due back. However, I have found that even with the information to make an informed decision, emergency situations often create urgency, and all too often, the quickest, easiest solution wins out over reason. I want to thank you today for your time. I appreciate the opportunity to represent the tens of millions of payday lending customers across the country, many of whom I represent. We each have our own personal reason for going to a payday lender, but I think that almost all of us would agree that while this is not a perfect option and it's not right for everyone, we are very grateful that the option was available when we needed it. Thank you.
Thank you very much. I appreciate the testimony of all of the witnesses. First, let me take, in terms of my 5 minutes, I think it is probably better to talk about a specific amount of money in relationship to $100 or in terms of a service, because when you do the APR, I'm not quite sure you can compare an apple to an apple, an orange to an orange. That's just my point of view. People can continue to use the APR argument if they wish to do so. I would like to share with Mrs. Fox that I appreciate her testimony, and I would like to have an opportunity, hopefully. I addressed a group of consumer groups earlier today, this morning, so that we can begin the process of dialogue and open communication, because it is clear, given her testimony, that you don't grasp the bill and what our goal is in the bill. First of all, I want to make sure that everybody understands what our bill does. It allows you 6 payments, 13 days apart for 78 days, and including the 14 days, that's 92 days. But if you listen to the testimony that was given earlier, you would think that you could simply roll it over. Well, we have a ban on rollovers. We have a ban on non-sufficient funds and being able to submit a check for non-sufficient funds. And our APR is actually lower than Louisiana, which is at 521. We reduce it to 391 because we specifically relate $15 to 100. And then, of course, they said, well, they got around the bill. Ms. Fox says that, and she's right. This is not an installment loan protection program. This is about the payday industry. We hope in the near future to be able to deal with installment loans, but that's not what we're talking about today. If people change the nature of their relationship with those providing funds to them, and then those changes should not be attributed to this measure. This measure, as many of my colleagues who are supporting understand, is a measure which will allow us to take 23 states and over 100 million people who do not have these protections today and be able to encourage them. Mrs. Fox, in your testimony, you assert that H.R. 1214 would provide congressional approval for payday lending. I find the argument confusing. See, by not acting to curtail payday lending in over 18 years, it has gone from 300 storefronts to 24,000. And so has not Congress already provided its approval? 19 million Americans participate in legal and authorized payday lending. Wouldn't federal regulations on payday lending demonstrate that Congress is paying attention and ready to regulate the industry? Is your argument that no federal legislation on payday lending would send us a message that Congress disapproves of payday lending?
Thank you, Mr. Chairman. The action that Congress has taken on payday lending to date has been to ban this product for service members and their families. In 2006, you enacted a provision in a defense authorization bill to put payday lending off limits to service members at the request of the Department of Defense, because this product was viewed as being harmful to them. Typically, small loan products are regulated at the state level, where state laws authorize certain types of lending, like installment lending, pawn shops, or payday loans. Typically, Congress does not enact authorization bills for specific products. You have overarching laws like truth in lending, which require all creditors to tell consumers what their loans cost.
I guess I understand those things, and since even though I'm the chairman, my time is still limited to 5 minutes.
Yeah.
The issue here is
Yeah.
whether or not we wish to take 23 states and over 100 million consumers and offer them a protection they do not have today. And so I guess, would you like to see rollovers eliminated in 23 states, which this bill does? Just yes or no, because I know my time is waning.
This bill doesn't stop back
It
to
does.
back
It
lending.
it
so
does.
doesn't
It does
limit
do that. And so we'll
rollover.
have a continuing conversation about it, because it does, and it specifically states that, you know, if you wish to be against the bill because you wish us to do nothing other than eliminate payday lending, which in your statement anybody can read and extrapolate, Mr. Fox, you don't like the payday, I don't like the payday, you wish to eliminate it, you wish to ban it. That's not possible. That's not possible. So what we're trying to do, many of us, is to reform that very system that many of us, and as I stated earlier, we'd like to take the columns over, but that's just not possible. So as we look at those situations in this Congress, and I just would like to say to the lady also that, you know, I began the amendment process for the military servicemen here in this committee that got it down to 36%. We were successful in that venture. I think I have a good gauge of what is and can or cannot be successful. But I'll work with you, because the only bill that we've gotten after I've introduced this bill is a bill that makes it harsher on consumers vis-a-vis the payday industry. I look forward to working with those that have the ability of doing better. I yield the gentleman, Mr. Henseling, 5 minutes.
Thank you, Mr. Chairman. Okay, Ms. Fox, I guess I have to bite on this one. I think I heard the chairman said, and I'm not sure I completely heard you make this definitive statement, but is it the position of your organization that payday lending should be banned, period, paragraph?
It is our position that consumers should be protected from triple-digit interest rates. They should not be exposed to writing checks without money in the bank as security for a loan, and they should have an affordable repayment schedule.
Well, unfortunately, Ms. Fox, I have a
loan
short period of time. You
affordable.
would do well in this institution as well. We're not particularly good about giving yes or no answers either. I am curious, and I'll throw this open to anybody on the panel. I believe that the best consumer protection is a competitive market. I've spent a number of years in the business world. I think I've got history. I think I have evidence. If I did my own homework properly, I've at least seen studies that tell me that there are over 22,300 payday stores in America. I saw one study from a particular state that said there were more payday locations than McDonald's, Burger King, and Wendy's combined. I had my staff pull the yellow pages out of Dallas. I'm a Dallas resident. There were over 125 different payday locations, 46 locations of Ace Cash Express, 25 of Cliff's Check Cashing, 14 Advance America, 13 Check and Go, 10 Easy, 7 Check into Cash, 6 Federal Cash Advance, 4 Speedy Cash, and too many Cash America locations to even count. To me, it seems like a fairly competitive market, and I am fearful that the underlying legislation might make it less competitive. Does anybody want to take the opposite view that there is a competitive marketplace? Seeing none, let's talk about what might happen if we lacked competition in that market. The gentleman from North Carolina, who isn't here at the moment, because I saw him speaking on the floor out of the corner of my eye.
One of them is.
Well, the gentleman who agrees with me is not. The one who introduced the Federal Reserve study into the record, I'd like to quote from that same Federal Reserve study, which investigated how consumers fared after payday lending was essentially banned in Georgia and North Carolina. I'm sure the gentleman from North Carolina will have an opportunity to speak to that. But the Federal Reserve study concluded, quote, compared with households in states where payday lending is permitted, households in Georgia have bounced more checks, complained more to the Federal Trade Commission about lenders and debt collectors, filed for Chapter 7 bankruptcy protection at a higher rate. North Carolina households have fared about the same. This negative correlation reduced payday credit supply, increased credit problems, contradicts the debt trap critique of payday lending, but is consistent with the hypothesis that payday credit is preferable to substitutes such as the bounce check protection sold by credit unions and banks or loans from pawn shops, end quote. That from the Federal Reserve. Does anybody wish to take issue with their conclusion on the panel? Ms. Fox, we'll give you a short amount of time.
Yes. When studies are done that look at actual payday loan borrowers, they find that they are better off without this product. For example, in a large Texas study, payday loan borrowers are twice as likely to end up in bankruptcy in the next 2 years as people who applied for and were turned down for the loan. Mr.
Well,
Morgan.
Ms. Fox, do you not believe the earlier testimony as far as the various APRs? I think the gentleman from Louisiana talked about the average fee for bounce checks, reconnect fees.
Yeah.
Do you doubt that evidence?
Absolutely not. As we testified earlier in March, we think overdraft loans are the bank equivalent of payday lending, and this committee can deal with that by enacting Representative Maloney's H.R. 1456.
Well, I could, in the remaining
Representative
time I
Spears'
have, I'm
rate
going to
cap
try to
bill.
get another question in here if at all possible. But I know we just had this debate on credit cards, and yes, credit card terms can be confusing. I've walked into a number of payday stores in Dallas, Texas. Fees are right there on a big board. It's not confusing to me. I talked to several customers. They seemed to know exactly what they were doing, and they were very happy to have that option versus a lot other alternatives that were less so. Mr. McCullen, in Louisiana, are these hard to understand transactions?
No, so they're not.
15 seconds, Mr. McCullen, to answer the question.
They're not. Everything is posted and listed on the promissory note, and the customer understands exactly what the fees are. There's no hidden fees.
Is there any time for one additional brief
No,
comment?
I'm
Okay.
sorry. You might get a little later on. I'm sure we'll come back to you, Ms. Guzman. So we have about 11 and a half, 12 minutes. I'm going to stay and listen to the I'm going to stay and listen to the gentleman from North Carolina, as it's already been kind of prepped up. We don't want to take a break. So gentleman from North Carolina is recognized for 5 minutes, and then we're going to go vote and come right back.
Thank you, Mr. Chairman, because I may not be able to come back, and I appreciate you getting my questions in or comments in before I leave. First of all, I want to start by inviting all of my colleagues who say they believe in states' rights to come on back and join the states' rights caucus that I've been trying to remind them they've deserted. I have no problem with helping these 23 states, but when the chairman says that we can't ban payday lenders, that's exactly what we've done in North Carolina, whether I agree with it or don't agree with it. We've got a state legislature there. They've considered this issue. And and I've been trying to decide, trying to review the bill to be clear on whether it does preempt state laws or whether it does not preempt state laws. To the extent that it preempts state laws, North Carolina's law, it may well be helping the 23 states that the chairman said that it helps, but it's overriding North Carolina's law, which says you can't do this in North Carolina. So unless we can write this bill in such a way that the provisions of it are a true floor as opposed to a preemption, I have serious problems with it, and I don't read these provisions to do that. So,
will the gentleman enter in a colloquy with me?
I'm happy to
Sure.
yield to the chair.
That is the intent of the bill, not to preempt.
I've been told that.
But if I could just, and I look forward to working with you because I know you're really good at the law and drafting legislation so that we can make it as explicitly as possible to make sure that we reach that
I
goal.
just want to make clear that when you find all of these folks who are supporting this bill, when you make that clear, the room will get a lot more scarce than it is today.
And
if this bill is a floor, and we are explicit that it is a floor, then I think we're moving the state of the law forward. But if it is an exemption, a preemption of state law, then in North Carolina we haven't moved I mean,
will the gentleman yield to me?
My legislators tell me they don't want payday lending in North Carolina.
Will you yield to me?
I'm happy.
Let me put it, it'll be a lot easier, my friend, because if that isn't accomplished, and I know that you and I can get that done explicitly in this legislation, then the room won't be empty or full, because I'll simply withdraw the legislation as the sponsor and ask my colleagues to it will cease to exist as a bill if we are not. And I look forward to working with you because I know the clarity with which you can write this legislation.
I'm glad to hear that from the chair, and I hope everybody in the room heard it.
Would the gentleman yield for 1 second?
I'm happy to yield to my gentleman friend from Georgia.
Thank you very much, gentleman from North Carolina. Our case is very similar in Georgia, where we also have outlawed the payday lending. And as a co-sponsor of this bill, I can assure you that we will make, if it is not clear as is, we certainly will make sure that it is clear. And the chairman has spoken to that.
I'm reading the language on page 10. Requirements of this subsection regarding extended repayment plan shall supersede any repayment plan requirements under any state law. I don't know what that means. Perhaps we'll be able to clarify it. I'm reading that we've preserved to attorneys general enforcement authority. That's on page 16 of the bill. But I'm also reading scope of application. The provisions of the section apply to any person or entity that seeks to evade its applicability by any device, subterfuge, or pretense whatsoever. North Carolina has done it openly, not by pretense, subterfuge, or device. They've done it openly. So, I mean, if your intent is that, and we can get there, I'll be right there with you.
Thank you. Time of the gentleman has expired. Okay. I wanted you to have the opportunity, and Mr. Royce has a question, so we'll try to get that in. I would encourage people to go vote, and we'll be right back.
Thank you very much, Mr. Chairman. In light of the time, let me just ask this question of the witnesses. You know, some often refer to payday lending as predatory in nature, but on that topic, the New York Federal Reserve, and this was during the time that our current Treasury Secretary, Tim Geithner, was the bank's president, and they did a study entitled Defining and Detecting Predatory Lending. And in that study, they come to this issue of payday lending, and they note, quote, our findings seem mostly inconsistent with the hypothesis that payday lenders prey on, for example, lower the welfare of households with uncertain income or households with less education. Those types of households who happen to live in the states that allow unlimited payday loans
are less likely to report being turned down for credit, but are not more likely, by and large, to report higher debt levels, contrary to the overborrowing prediction of our model, unquote. So I was going to ask Mr. McCullen, do you agree with the New York Fed's assessment of payday loans? Doesn't the presence of a robust short-term credit market, in fact, benefit some consumers by increasing the availability of credit to them? I'll also ask Ms. Flores that question.
Yes, sir, Mr. Royce. People use us for all kinds of different reasons, and it's a line of credit almost that people can use at any point.
And Ms. Flores, your observations on that front?
I am in full support
Mr.
that
Flores.
availability of payday lending will certainly assist those consumers.
We have 5 minutes to get over and vote.
Okay.
We'll make sure you get all your time when we get.
Well, I'll just conclude then, Mr. Chairman, by saying let's make sure that, you know, in terms of that credit availability for people, you know, that try to access credit, let's make sure that they're allowed, that, you know, that we don't foreclose that option for them as we move forward. And again, Mr. Chairman, thank you.
Yes. We're going to recess for the vote. I have an emergency meeting I need to go to. Mr. Ellison will be filling in for me when we get back.